Mr. Dudley, thank you for joining us. Talk to us about what you think about it is now about the destination, no longer the journey, and how you're thinking about a path to a terminal rate above 5%.
Well, the Fed was very careful today in how they messaged the slowdown in the pace of tightening that's going to come sometime in the next meeting or two by focusing on the fact that the peak in the federal funds rate today looks like it's higher than what the Fed thought back in September when they published their quarterly summary of economic projections. As you recall, back then it was 4.5 to 4 3/4 where the Fed thought they were going. Powell said that the information today, that's been received since that last meeting, pointing to a higher peak in the federal funds rate. The other thing that's, I think, really important about today's meeting is the Fed has basically made it very clear that they're emphasizing the longer more than the higher. And if you look at the federal funds futures market, that's how the federal funds futures market heard the message today. The rates for, through March of 2023 didn't change very much. But further out, people have now realized that it's not just up and then back down. The Fed's going to keep that peak in interest rates for quite some time until they actually see improvement in the underlying inflation outlook.
And, of course, the underlying inflation not moving very quickly at the moment, Bill. And I'm interested as to what you therefore gain or garner from a very strong labor data. We got it in the JOLTS, likely to get it in non-farm payrolls later this week. Any signs that inflation for you is starting to cool? Anything in the here and the now that paints that this is the time we should be taking our foot off the accelerator and the size of the hikes going forward?
Well, I think so far that the news on inflation has been disappointing, and the news on how tight is the labor market has been disappointing. Labor market is still really tight, and best evidence of that was yesterday when we got the job openings and labor turnover report, which showed the number of unfilled jobs relative to unemployed workers tick back up again. So far the Fed hasn't really made much progress in generating slack in the economy, which is necessary to push inflation back down to 2%, and that's why the Federal Reserve is going so quickly. 75 basis points move, and why they're not finished yet. It's going to take time, and I think that's how the markets have interpreted the Fed's press conference today, Powell's remarks. We're going to be higher for longer, and that's why the stock market, which initially rallied in response to this notion that there are long lags to monetary policy, pivoted back down to becoming more pessimistic again when they realized that, no, this is actually a hawkish message, not a dovish message.
What's the interpretation here, Bill, of cumulative tightening, though, in and of itself? I mean, what does that mean to you?
Well, I think the Fed has basically said that we want to take monetary policy to a restrictive monetary policy setting. That should tighten financial conditions. Those tighter financial conditions should slow growth, push up the unemployment rate, and eventually that should weigh on inflation. The other thing I think that Powell stressed today is it's going to take some time for all this to play out. First, you raise interest rates, then you tighten financial conditions, then the tighter financial conditions affect growth, and then only then does it have implications for inflation. So it's way too soon to expect much progress on inflation because the Fed hasn't actually generated any slack yet in the U.S. labor market.
Well, what about financial markets? So, I mean, he was asked this question by a couple of folks, including from Mike McKee here at Bloomberg, the idea of when you look at, the near-term forward spread curve, the idea that if it's not negative, I think it's right around zero, and the idea that financial conditions have continued to tighten. Does that not count?
Well, I think he's happy that financial conditions have tightened. I mean, Powell has said very clearly that monetary policy works through financial conditions. We want financial conditions to be tighter because that's the mechanism that slows down the economy. So rather than being unhappy about the stock market going down a bit and bond yields going up a bit, that's deliberate. That's what the Fed wants to happen to slow down the economy.
Can you talk to us, though, about how they tie that into communication? Because the chairman today acknowledged that it used to be you raise 25 and financial conditions and financial markets react. Then today he finally acknowledged the markets and financial conditions are reacting months before he even hints at a change in policy. Does there need to be a change in some of the communication from the Federal Reserve?
No, I think what he's really acknowledging is the fact that the Fed is much more transparent about what their plans are for monetary policy in the future. So you can look at the quarterly summary of economic projections and see where the Fed is projecting interest rates out into the future. the market reacts to those projections today. So the Fed doesn't have to push the federal funds rate to 4% before the market reacts to the fact that the federal funds rate is going to be at 4% by the end of the year. So the point that Powell was making is that monetary policy in some ways works faster than it used to because the markets anticipate what the Fed is going to do in the future.
Yeah. And global markets are that, Bill. And you wrote a great piece back on October the 10th talking about how the Fed owes the world a mea culpa. The fact that this isn't the Federal Reserve just to the US, this is the central bank to the world, the ramifications coming through the US dollar at the moment. I'm interested as to whether you thought he spoke enough about the knock-on effects. And you said it before, look, the US can't worry too much about that, but there's something more that they can do to alleviate the pain?
Well, I think he feels that the best thing that the U.S. can do is run monetary policy well and get inflation under control. That's good for the United States, and it will ultimately be good for the rest of the world. I think the Fed understands the fact that the U.S. monetary regime, as it's unfolding, is making life more difficult for other countries, especially those countries whose currencies are under downward pressure. But there's not really much the Fed can do about this. You know, at the end of the day, the Fed has to do their job, and if that job causes pain for other countries, that's just the way it has to be at this point.
There's also been some concern, Bill, that Powell and the rest of the members of the Fed are still relying on a lot of backward-looking data, as most of us are here, and whether there's any sort of policy prescription, if you will, for lack of a better phrase, that maybe can be a little bit more forward-looking, that maybe makes the Fed a little bit more effective in real time in addressing their tightening and its effects on the economy.
Well, you'd always like to have a really good crystal ball, but I think you have to give the Fed a little bit of leeway here. We haven't had experience going into a pandemic like this or the recovery from the pandemic before. So I think it was very difficult to forecast, you know, what was actually going to happen to inflation, what was going to happen in terms of the tightness of the labor market. And what we found is that inflation was more persistent and the labor market was tighter much sooner than expected. You know, some of that it was a forecasting error on the behalf of the Fed, but we have to recognize the fact that it was much more difficult to forecast because this is a very unusual economic environment.